Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, good afternoon, everyone. It is now 4:30 p.m. here in New York, so we're going to start off this afternoon's webinar. Thanks to all of you, for joining us. Today's session will be hosted by Dan Sugar. He will be going through the second part of this two-part beginner series covering all about ETFs. For those of you who are not familiar with him, Dan is a third-generation Chicago trader who entered the trading world as a runner on the floor of the Chicago Board Options Exchange in 1980. He spent 8 years trading Treasury futures and Dow Jones Stock Index futures on the floor of the Chicago Board of Trade. In 1996, Dan left the floor and began trading stocks, futures, options, and Forex from the screen. Dan helped students learn how to gain financial independence using his knowledge and real-world experiences, as well as giving them the rules and tools to succeed. So we're going to go ahead and turn it on over to Dan at this point.
Thanks, Katrina. Great to be with everybody. Thanks for coming. And thanks for the International Securities Exchange for giving us a little platform here about some great ETF content. So we got an hour, and I got a lot of good information about all types of different ETFs. If you're here tonight and you happen to miss part one, about 4 or 5 weeks ago, I did part one all about ETFs. I'm sure it's archived on the International Securities Exchange website. So feel free to glance at that because there's a lot of good information in part one as well. So wanted to welcome everybody and get going and use this time wisely. We've got a lot of great information. I wanted to start off by talking a little bit about seasonality. Before we get into the ETF content, a few words about seasonality regarding the stock market, going back 100, 125 years of equity trading in stocks. A lot of people think that October is the most bearish month of the year. Actually, because we've had two crashes, 1929 and 1987 was in October. But historically and statistically, September is the most bearish month of the year. And actually, October is second most bearish month. But back to back, we're in a pretty bearish selling time frame right now, September 21st here. So today's sell-off with the Fed did not surprise me at all. Actually, we took out some trend lines, and we had a supply zone the last couple of days. We've had a nice rally for a while, and this little 3 or 4% pullback did not surprise me at all, and I'm actually long some inverse ETFs, so your humble instructor this evening is in a very good mood because of that sell-off. I'm long TZA and SDS, QID. So anyway, it didn't surprise us. We teach this in our classes, all about supply, demand, and trend lines and so forth, so we were prepared for this nice drop. And but getting back to seasonality, you may have heard of the Yale Verse Organization, the Stock Traders Almanac. It's about a $40 or $50 book, and they did all this back testing on seasonality, which months are strong historically, which months are weak, and it doesn't happen every year, but right now, I mean, September and October are very bearish months. In August, the first week of August, the second week of August, 5 or 6 weeks ago, we had some monster volatility, mostly to the downside. So it's not over. We're going to get some more volatility between now and Halloween, so buckle up and put your seatbelt on because it is a bearish time here. So there's the old saying, sell in May and go away. That was from Yale Verse Organization because the period from October to May has been twice as bullish as the period from May to October. So again, cyclically and seasonally, we're in a very bearish time frame here. So just be careful, watch the downside. And don't be surprised if between now and October 31st, if some more GDP numbers come out bearish, or retail sales, or housing, or unemployment, non-farm payrolls, or initial jobless claims, or leading economic indicators. Don't be surprised if we really pick up some steam on the downside. Getting into late October, it could be a good buying opportunity because a lot of times after that selling is done, we hit a demand zone and we rally into Halloween to Christmas, nice fourth quarter Christmas rally. Many times. But I want to speak a little bit about seasonality before we get into the ETFs because it's very apropos because we're right in the middle of September and we're in a volatile period. And just watch the downside. If you're getting long and watch your stops to the downside, but don't be alarmed if we really exacerbate and take out those August lows. We could definitely take out those early August lows, and Dow could be heading back to 10,000, and S&Ps could be heading back to 1,000 or 1020, those old August lows. So keep on the downside because seasonally the odds are favoring some more selling. Okay, so let's keep rolling here and get into today's content here with the ETFs. So a little bit about Online Trading Academy. If you've never heard of us, I've been an instructor there and I've been working with Online Trading Academy since December of 2007, December 2007. So about 3.5 years now working with Online Trading Academy. For me, I really enjoy teaching and getting away from the screen 7 or 9 days per month and teaching new and aspiring traders the proper rules and tools to be successful. So we're one of the leaders in the online trading education industry, founded in 1997 out in California, 37 branches around the world, 5 countries, Singapore, Dubai, Abu Dhabi, Indonesia, India, Ireland, London, and Canada. We just signed a deal to be in Hong Kong, so we're going to be there shortly. We have about 25 or 30 branches all around the United States in the major metropolitan areas. I'm actually broadcasting live today from Milwaukee. I've been here since Saturday teaching, and I have 2 more days on Friday. And I'll fly home and be ready to trade next week from my home office. But right now I'm in Milwaukee, Wisconsin, so it's great to be with you. We do cover all the different asset classes, stocks, options, futures, currencies, and as proactive investing class as well regarding 401k, IRA, and your big bucket retirement stuff. We do offer a free 4-hour power trading workshop at all of our branches, so go online, do tradingacademy.com, and search for your local branch, because I highly recommend you to take a free power trading workshop to find out who we are, what we're about, and what type of curriculum we offer. And we do have the physical branch offices, so good to see you, Manu. I recognize you, Manu, from Detroit. Thanks for coming, Manu. Great to see you. Okay, so go to our website, find out your closest branch, and definitely take us up on our free 4-hour workshop, and we'll buy you lunch just for coming. All right, so today's lesson plan, we're going to cover some more information on types of ETFs. We're going to dive into deeper on leveraged ETFs. A lot of misinformation, a lot of lawsuits really about how leveraged ETFs work. So we're going to clean that up and go into detail about the inverse and the leveraged ETFs, the 2-to-1, the 3-to-1 leveraged ETFs, which I call the ETFs on steroids. We're going to cover some information on international ETFs today. You can buy ETFs that cover Brazil, Russia, India, and China, the BRIC countries, Hong Kong, Australia, Canada, and so forth. So we're going to cover some information on international ETFs. One thing I want to give you guys and gals a heads up is if you want to get a pen or pencil and a legal pad or something to write with, because I'm going to cover a lot of the symbols for these different types of ETFs. So take notes, and I just want to give you a heads up possibly to get a pen or paper. Maybe you already have that, but you want to write down some of these symbols, okay? Then we'll have some time for Q&A as well. So I wanted to start out with the big 4 stock index exchange-traded funds. You've heard of spiders, QQQs, diamonds, or DIA for the Dow, and IWM. These are the ETFs that track the 4 big cash stock indexes. SPY is actually the oldest and largest ETF out there, started in late 1993. So it's 17, 18 years old. Spiders have been around for 17, 18 years. QQQs was the next one. Diamonds have been around for a while, and then IWM is the ETF that tracks the Russell 2000. What I also have up on the chart here, gang, is ATR is average trading range. So on average, looking back the last 20 trading periods, what's the difference between the high and the low? So this data is current as of actually March and April, so it could have changed a little bit since now that we're in September, but this is current as of March or April. So on average, the spider averages about $1.15 per day between the high and low, plus if there's any gaps. So it's got a pretty decent range every day. ADV is the average daily volume, how much volume they average per day between 9:30 and 4 o'clock East Coast time. So the spiders do about 128 million shares per day. Pretty active, a lot of transactional volume every day. The QQQs has about a 56-cent range between the high and low, including any gaps, and it does about 53 million shares per day. The diamonds, or the ETF that tracks the Dow Jones Industrials Index, has an average trading range of about 84 cents per day. The Dow cash averages about 90 points or 100, 110 points per day, roughly. But the diamonds is about 84 cents. Again, it could have changed a few pennies up or a few pennies down since March or April when we got this data. As far as volume on the diamonds, it does about 7 million shares per day. So a lot less than spiders and Qs, obviously, but more than 1 or 2 million. So it's still very liquid. It does have a tight spread between the bid offer, and it's easy to get in and out of. The IWM has about a $1.05 range. That's the Russell 2000 ETF that tracks the Russell small cap index. The Russell 2000 is the 2,000 largest small cap issues. So those are small up-and-coming companies. People are trying to find the next Baidu, the next Google, the next Apple, and so forth. They start with small caps. And that does about 45 or 50 million shares per day as far as volume. All have options too. A lot of the options on the ETF trade right here at the International Securities Exchange. And they're all very liquid. Again, very tight spreads between the bid and offer, and a lot of different strike prices. The other thing I wanted to mention about these 4 stock index ETFs, besides being stock indexes, they really have a lot, not much in common. Besides being stock indexes, there really are different personalities, different nuances between the 4 big indexes. And let's start with the spiders. That's the S&P 500. It's a broad-based stock index. A lot of money managers and mutual funds, Fidelity and Vanguard and T. Rowe Price and Northwestern Mutual and American Century and so forth and Franklin Resources, their money managers and mutual fund managers are trying to beat S&P 500. So it's a big gauge or barometer of how many money managers can actually outperform the S&P and how many underperform. And it's tough. Not too many money managers can outperform the S&P, for more than 2 or 3 or 4 years. So that's a good argument for indexing. At least part of your portfolio, you can buy ETFs that just mirror and track an index, and whatever the index gets for the year, you're going to get for the year, give or take a few tenths of a percent or so. So the S&P is 500 stocks. One thing to keep in mind about the S&P, gang, is that 2/3 of the S&P 500, or 330 stocks out of the 500 that are in it, 330 stocks of the S&P 500 derive half their profits and revenues from overseas operations. So it's really an international index. Boeing, Walmart, McDonald's, they sell a lot of products, services, and Big Macs in Europe and Asia. So one thing to keep in mind on this, if you're going to trade spiders or SPY options or SSO or SDS or some of these leveraged or inverse ETFs on the S&P, which we're going to cover later today, or even the S&P futures, it really helps you to keep an eye on the dollar, the U.S. dollar index, the Dixie, because if we have a weak dollar, that can put tailwinds underneath the stock market to go up. There's a nice inverse relationship many times between the dollar and the S&P, because if our dollar's going down, Europe and Asian customers can buy our goods with a weaker dollar, a lot more of our goods with a weaker dollar. So it's not 100% correlation, but 2/3 or 3/4 of the time, when the dollar's going down, it can put a bid underneath the S&P and some tailwinds up. If the dollar catches a bid, like it has the last 2 or 3 weeks, we kind of broke out of a nice range to the upside on the Dixie U.S. dollar index, it can put some headwinds on the stock market. And obviously, we've had some sell-offs lately. So keep in mind that correlation, the relationship between the U.S. dollar and the S&P 500. Because 2/3 of the companies in the S&P 500 get half their profits from overseas operations again. So the S&P is the big broad market where a lot of money managers try to beat the S&P, and it's a big broad market, 500 stocks. QQQ is going to be the ETF that tracks the NASDAQ 100. And there's 2 different NASDAQ indexes, gang. There's the NASDAQ Composite, which has about 3,000 or 4,000 stocks in the NASDAQ Composite. And then there's the NASDAQ 100. So there's 2 different indexes from the NASDAQ. The NASDAQ 100 only has 100 stocks in it. Thus it's called the NASDAQ 100. And then the QQQs is an ETF that tracks the NASDAQ 100. And the NASDAQ 100 is the 100 largest non-financial stocks that make up the NASDAQ Composite. So it's heavily geared towards technology. Apple, Amazon, Google, Qualcomm, Baidu. Those are going to be the big stocks in the NASDAQ 100. You have Whole Foods is in there, Bed Bath & Beyond, some other stocks that are not tech-based, but 3/4 of it or more is technology-based. So that's the QQQs, very heavily weighted towards technology. And if you notice, before today, the last 3 weeks or so, technology has been leading us in the rally. Technology was the strongest. They took out some supply zones and were strong, because Apple went from 385 to 424 pretty quickly. So Apple is 12% of the QQQs, by the way. Prior to May 2nd, Apple was 22% of the QQQs, but we rebalanced May 2nd, and now Apple's 12% of the QQQs. The QQQ, or the NASDAQ 100 index, is going to be a market capitalization index. So the bigger the market cap of the stock, the more influence it's going to have on its day-to-day net changes. So now Apple's 12%. If you trade the QQQs or the QID or QLD, the leveraged or inverse ETFs we're going to cover later, or mini NASDAQ futures or options in the Qs, if you trade any one of those products, you have to keep an eye on the top 5 or 6 stocks that make up the NASDAQ 100, which is going to be Apple at 12%, Apple, Amazon, Google, Qualcomm, Microsoft, and Intel. Those 5 or 6 stocks have a big weighting on the NASDAQ 100, so if you're trading Qs or QQQ options or the other inverse or leverage ETFs we're going to talk about later today, QLD, QID, or the SQQQs, the triple Qs, you've got to keep an eye on those 5 or 6 stocks. Again, Apple, Amazon, Google, Qualcomm, Microsoft, and Intel have a big impact on the day-to-day fluctuations of the QQQs. So that's the technology index. And when the diamonds, the Dow Jones ETF that tracks the Dow Jones Cash, is called the Diamonds DIA. Everyone should be familiar, if you've been around investing in mutual fund and trading arena for a while, if you're familiar with the Dow Jones Cash. And Diamonds is the oldest and largest index, heavily quoted from Neil Cavuto, Maria Bartiromo, and all the talking heads on CNBC and Bloomberg and Fox. That's the oldest and largest index, but it's really not a great barometer of the whole stock market. The Diamonds in the Cash Dow is 30 stocks. It's 30 multinational, blue chip, dividend-paying stocks, but it's only 30 stocks. So some people make the mistake of, if the Dow's strong, it doesn't mean the rest of the market's strong, and if the Dow's weak, it doesn't mean the rest of the market has to be weak. It's only 30 stocks. It's very narrowly based. Now, the one thing to keep in mind about the Dow, gang, is that the Dow Jones is going to be price-weighted. The Dow Jones is the only index that's price-weighted. It's not market cap-weighted. So if you trade diamonds or diamond options or mini Dow futures or DDM or DOG, the inverse and leverage ETFs we're going to talk about later on the Dow, you have to keep an eye on the top 4 or 5 expensive Dow stocks because it's a price-weighted index. So companies like IBM at 170 or 3M or Caterpillar at 70 or 80 or 90 bucks a share have a lot more influence than Cisco at 14 or 15, or Bank of America at 6 and change. So if you trade diamonds or diamond options or the mini Dow futures or the leverage or ETFs on the Dow, you got to keep an eye on the top 4 or 5 most expensive Dow stocks. Again, 3M, IBM, Caterpillar, Boeing, McDonald's, because they're going to have much more influence day to day on the Dow than Bank of America and Cisco, because those are low-priced Dow stocks. And then we have the IWM, the Russell, the small cap. The 2,000 largest small cap stocks are a big part of the market. And one thing to keep in mind, gang, also, another big point is I call the Russell. Let me ask you a question. In a healthy bull market, which 2 out of the 4 indexes do you think should be leading? In a healthy bull market, which 2 out of the 4 on the screen should be leading? Type it in the chat box and we'll give you a little quiz here. And if you have an idea out there, Manu, you should know this because you had me live in Detroit a few months ago in that ETF conference as well. So the Russell and NASDAQ technology should be leading. The QQQs and Russell should be leading the bull charge in a healthy bull market because there's more risk, but there's more reward in those types of stocks. Dow Jones and the S&P are going to lag because they're blue chip dividend-paying stocks. They're not going to race and sprint higher as fast as the Russell and the QQQs. So I call the QQQs and the IWM, I call those alpha indexes. So again, they're all 4 stock indexes, but they really have a lot of a lot of different personalities. The IWM is small cap, diamonds are the Dow 30, QQQ is technology, spiders are the broad base. So keep an eye on those. Okay, so a little information about. And even if you don't trade the Russell or NASDAQ, you're trading diamonds or S&P or Dow Jones stocks or S&P stocks, you need to keep an eye on the Russell charts and the QQQ charts because In a bear market, they're going to lead to the downside also. A healthy 15 to 20% correction or bear market, the Russell and NASDAQ are going to lead to the downside because investors and traders are going to dump their Russell and NASDAQ stocks before they get rid of their tried and true blue chip multinational dividend paying companies that make up the Dow and the S&P. So keep an eye on those. The Russell and the technology QQQs are alpha indexes. A little bit later we're going to talk about some alpha sectors, and we'll get into that as well.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.